But let's welcome our next guest. We have Hiren Ved now joining us, the CEO, Director and CIO at Alchemy Capital Management. Hiren, good morning. Thanks for joining us. Hiren, what's the call on the market, especially the broader market where we have had a massive rally? The small cap index is up over 35% this year. And, you know, a lot of people are complaining about the valuations as well. Your views?
So I think, Anuj, we have seen a broader market participation from November last year, actually. And I think that, in our opinion, there is a clear regime change that is happening as compared to what the markets were, let's say, in 2018 and 19, when it was very narrow and very few stocks at the top delivered returns. I think as the economy recovers, from the pandemic blow, I believe that the breadth of the market will improve and is here to stay. But as we all know that, nothing goes up in a straight line. So you will have these occasional bouts of correction. And I think it's fair to say that there was a little bit of euphoria that was being built in many low quality stocks. And I think an occasional correction is a good thing for the markets because it brings some semblance of sense back. But on the whole, we continue to be, very, very constructive on the broader markets. I think the breadth of the market improving and many more sectors participating in this rally is definitely going to happen into the future.
Okay, Hiren, good morning. But, we also had a phenomenon where we saw a lot of penny stocks rising, 1,000% in the past year. Our head of research wrote a very interesting piece over the weekend calling them the 1,000%ers. Because there was money aplenty, we saw all kinds of stocks rising. I mean, some of the names, McLeod Russell, CG Power, GTL India, Ratan India, Saregama, Jayaprakash Associates, Reliance Power, Parsvanath. So many of them were running just, 1,000%. All the numbers I read you were 1,000%er stocks. Do you think the fact that the Fed is going to tighten may stop the run of penny stocks?
Well, I think whether Fed or no Fed, I think there has to be a fundamental basis for these stocks to go up. And if there is no fundamental basis for it to go up, then at some point in time, reality catches on, right? Now, whether that trigger turns out to be the Fed beginning to signal some sort of a tightening, so be it. But I think, it's very easy to get caught into the sway and euphoria of these stocks. Maybe some of them have fundamental legs to it. I haven't looked at any of these names, frankly. But I think, as I've said, that, when you have a broad-based rally, sometimes things tend to overextend itself. And one has to be really careful. That doesn't take away the fact that the breadth of the market will improve and is here to stay. Whether that justifies these kind of moves in penny stocks, certainly not. And I think, people should do their work and be very careful about buying anything and everything just because the markets are doing well.
Okay, well, the market is doing well in a sense. It's not as bad as one would have feared. There is a recovery, definitely. So now holding on to 15,550 on the market. Hiren, good morning. If one had to buy on a dip, what are the stocks or sectors that you like right now for the rest of the year?
So, Sonia, as I mentioned, we certainly believe that there is an opportunity in certain sectors which I think are in a secular upturn, like IT services, like specialty chemicals, and a few select pharma companies. I think these are all export industries and they are likely to do reasonably well. IT is in a structural up move in our view, so is specialty chemicals. And I think selectively even pharma should do reasonably well. Apart from that, on the domestic side, I believe that the time has come for sectors which were not doing well, the cyclicals, whether it is global or domestic cyclicals, and many sectors which have been in a long consolidation phase for a long time. Select auto companies, auto ancillaries, capital goods. I think those businesses are likely to do reasonably well. I think it is time that, cyclical sectors or sectors which are more linked to the economic recovery are incrementally likely to do much better than what we've seen in the last couple of years. So we continue to be constructive on the cyclical end of the market as well. And I think it's important to keep a balanced portfolio. I think the kind of very narrow focus on a few franchises that we saw in the last couple of years is definitely coming to an end. And I think the breadth is likely to improve substantially.
Okay, fair point. Well, the market's recovering now, and just a couple of stocks I want to point out. Bandhan Bank is up 6%. I think over the weekend there was this deal that Assam Chief Minister had signed, so on microfinance loans. I think that's perhaps helping that stock, so that's up about 5.7% or thereabout. And I think just keep an eye on ONGC. That's seeing a sharp recovery. On Friday it fell because of the Sensex exclusion, but with crude prices back to 74, I think that algo trade is back on ONGC, and that's why that stock is rising right now. Hiren, what about the commodity stocks? We've had a big run in some of these stocks, whether it's Tata Steel or ONGC or even of late Coal India. But your thoughts on how to approach some of these names now?
So Anuj, I think certainly we are of the belief that we are in a commodity super cycle. I think many people, many analysts as well as companies that have been in this sector have explained that there are structural supply constraints in the commodities market, and I think incremental capacity is not likely to come in very soon. And as the global economies recover, I think there should be a reasonably good demand shift, and there is also pressure on raw material prices. But as we all know, commodity cycles, even though they are in a structural bull move, they don't move in one line. So there will be odd occasions where prices will be softer, and the stocks will also react accordingly. But I think longer term, our belief is that we are genuinely in a commodity super cycle. I think the decarbonization trend around the world, and especially in China, is for real. And that trend is far more structural than what China has been doing recently to cool off commodity prices. So I think if one was to bet on the longer term trend of significant supply constraints and a structural move towards the ESG concerns and decarbonization of China, I think there is a case for a long-term structural bull market in commodities, and I think we are just seeing the start of it.
Okay. That's a very important point you're pointing out. That's almost like the way chemicals have benefited India because of trends in China. It's become a secular trend in India. So take that point, Hiren. Now I want your detailed views on two sectors, NBFC and real estate. Real estate has been on the longest bear run possible, probably from 2013 or thereabouts. And NBFCs have been a bear run from the IL&FS day. Practically from the IL&FS day, they haven't really been able to raise their head. So let me first discuss NBFCs and housing finance. Is this the time to get in? I mean, there is still the second wave which will be hitting them, and people are still talking about a third wave. We don't know how bad it can be or may not be, since everyone seems to be prepared. But is it a time to get in? Because some biggies are getting in, and a lot of good news. I mean, Centrum getting a small finance bank license. PNB Housing, there is an imbroglio, but ultimately there is a guy with a big pocket getting in at some price. If not at 390, he'll probably come at 410 or 450 or whatever is the next valuation price. We don't know. Piramal coming into DHFL. So do you think this is the time to just pounce into this place, NBFCs?
Well, Latha, I don't know whether it is a time to pounce, but I think, NBFCs had a great run in the previous decade, right? Yes. I mean, we saw solid growth. lot of groups getting into NBFCs, L&T had L&T Finance, and, every group wanted a piece of the pie. But IL&FS was a great moment of reckoning. And, usually this happens when what I call as the version 1.0 of the sector is over and done. It happened with IL&FS. There had to be significant pain thereafter. And I think the sector has gone through tremendous pain and challenges post-IL&FS and post-COVID. I mean, you couldn't have had a better Six Sigma event for NBFCs than the COVID crisis. So I think we are now likely to see a version 2.0 of this industry, where there will be fewer players, the industry will be consolidated, and there will be a few survivors and a few leaders who will come out of this. And I think that is what we are seeing, that, if you've been able to manage a Six Sigma crisis like the one that we saw from IL&FS to the COVID crisis, and if you survive, then I think there are brighter days ahead for NBFCs. But it is likely to be a very select club of few companies that will do very well, a few NBFCs that will do very well. And I think the sector continues to have promise. You mentioned about housing finance. I think housing finance is on a clear uptrend. I think the real estate industry is coming out of a long consolidation phase. We are reasonably constructive on residential real estate, because I think, there is going to be a strong demand with where interest rates are today. And people are wanting bigger houses with work from home, etc. I think that the secular trend of buying independent houses and bigger houses will continue. And therefore, even housing finance will do very well. But having said that, I think housing finance is also a very competitive space now. So ROEs are not likely to be like they were in the last few years, because, when banks don't want to lend to corporates, or they don't want to lend to unsecured categories, where do they go? What is the safest category to lend? And that is housing finance. And therefore, it's a very competitive to unsecured categories. Where do they go? What is the safest category to lend? And that is housing finance. And therefore, it's a very competitive space. But the good thing is that the opportunity is very large. So there is space for everybody to grow. But I think on the whole, I think NBFCs in version 2.0, some of them will, move to the next level. Like, for example, Bajaj Finance. I mean, it's a clear leader. It has shown that leadership. And I think the market is also rewarding it for that kind of leadership. But there will be many more, who will also do reasonably well. So I think we will have a much consolidated, a much stronger version 2 of this industry going forward.
Well, Hiren, I know you don't want to talk stocks, but only on this specific one, without telling us whether it's a buy or a sell, do you think that PNB Housing is really, although it is at the moment caught in a valuation issue, the fact that a deep-pocketed investor is putting in money still makes it an attractive buy on distress? Just this once, if you can speak about a stock.
So again, I mean, I haven't looked at PNB Housing, but as I said, that the very fact that there is institutional money which is willing to bet on the housing finance sector tells you that there is a very large opportunity in India ahead of us. And I think that this is also a sector which can absorb a lot of capital, right? And therefore, I think that inherently the asset is good. The current deal structure may have got complicated because of whatever reasons, but I think there is, in my opinion, that the sector remains fairly attractive for long-term investors. And I think the very fact that somebody was willing to bet a large amount of money tells you that there is potential to add. So undoubtedly, in my opinion.
Okay, by the way, the market is picking up quite a bit of pace now, recovering from the lows, and a lot of FMCG stocks are doing well. HUL, by the way, is at a fresh record high this morning. It's up about 1% batting for the bulls, and it has Asian Paints and Britannia for companies, so both those stocks hanging on to the green line. Hiren, I wanted your thoughts on Reliance and this whole space, the telecom space, because there's the AGM coming up this week. The subscriber data has also been very strong. RelJio has done well for the earlier month, the month of March. But your thoughts on how to approach this space now? Do you see more structural upcycle here?
So I think, Sonia, this is, this has been a difficult sector for some time now because, of hyper-competitive pricing. But now the sector has got fairly consolidated. And I think that the investable universe is now largely focused on the top two companies. I think it's only Reliance and Bharti that are in the reckoning, in my opinion, who have scale and who have execution capabilities. So I think these are the only two stocks that one could look at. But I think in the telecom industry, in my opinion, the game is going to move beyond just voice and data. I think the game over the next few years is likely to move towards more value-added services on top of, connectivity in terms of just voice and data. And a player who's able to create that ecosystem where you could use your telecom network to deliver e-commerce services or media services, subscription services, and deliver value-added services to your customer base is likely to win in the future because, data and voice is now commodity. And, it is very difficult to now envisage that, we've been betting, the whole sector has been betting for a long time that rates will go up, but that hasn't happened so far. So that's a hypothesis which is not yet proven. And I think that, investors will have to think about not only just trying to make money in this sector because rates will go up, but rather to see who is able to create other revenue streams on top of, the customer base that they have developed. So I think that's going to be very interesting over the next couple of years. And as I said, the only two players who seem to have that capability, in our opinion, is Reliance and Bharti.
Okay. Hiren, what about some of these consumption names? And, especially in the QSR space, which have done so well over the last few days. Do you like the space? Do you have stocks in portfolio from here?
Yeah, I think the whole, the discretionary consumption and the QSR space, got hit last year, but I think they've done reasonably well and adapted themselves very well during the COVID crisis. Deliveries have become a very strong part of their business model, and I think that their ability to leverage their digital platforms and to leverage the delivery infrastructure which has been laid out is a clear competitive edge. And on the whole, we are quite bullish on this space. I think the opportunity is significantly big, and many of them have built a solid franchise in this area. So I think the entire consumer discretionary space, which got hurt last year because of the pandemic, is likely to do well as the economy opens up, and especially the QSR space, where companies have significantly adapted to the new environment and focusing on delivery revenues rather than just dine-in revenues, are likely to do very, very well.
Okay, well, let us end this conversation where we began, Hiren. You began by saying that you think there are a lot of opportunities in the mid-cap space. Can you elaborate a little more? I mean, there has clearly been a formalization of the economy. First demonetization, then GST, and now an unexpected COVID, which has also hurt the informal sector and helped the formal sector. So, I mean, what are the themes you would play? Basically, mid-caps and formalization.
So, Latha, let me, when I said, mid-caps and small caps will do well, that doesn't mean that large caps won't do well, for precisely the reasons that you mentioned, right? I think that there has been a significant formalization of the economy over the last couple of years for the, things that you mentioned. So there will be larger companies are becoming bigger as well. But my comment was more to do with the fact that this very selective rise in the market that we saw in 18 and 19 is not likely to persist. We are likely to see that the breadth of the market is likely to improve. And I think there are several sectors. I mentioned specialty chemicals. I think some selective API and pharma manufacturing companies. I think renewable energy. I think auto ancillaries, capital goods companies. I think there are a lot of these sectors which have not done well for a long period of time. The more cyclical oriented sectors are likely to do well. Now you've got to choose whether in those sectors you want to bet on the large caps or mid caps or a combination of both. I think both will do well, large and mid and small caps. I just believe that the breadth of the market will be much better from here onwards, and many more sectors will participate in this up move, like we saw between 2004 to 2007-8.
Okay, that's an important theme. We should actually begin with that, but that on another day. Thank you very much, Hiren Ved. It was a pleasure listening to you, and thank you very much for joining us with all your analysis and stock ideas. Okay.